Welcome back to Cheddar Business. The U.S. economy added more than 200,000 jobs in January, beating some economists' estimates. The latest jobs report also showed an unemployment rate of 3.6% and a 3.1% wage increase from last year. Joining us now to discuss, Francis Newton Stacy, Director of Portfolio Strategy at Optimal Capital, and Luke Tilley, Chief Economist at Wilmington Trust. Thank you both for joining us today. Luke, we'll start with you. Futures still pointing lower at this point to strong jobs number. What do you make of these numbers so far?
Well, in terms of the jobs number, it's obviously very strong, beating expectations by quite a bit, which is really encouraging. One other item that is in the jobs report is a big downward revision to the jobs from a year ago, so about 500,000 jobs taken out of the earlier published figures. So in a year-over-year sense, we're actually at some of the lows of the recovery, but obviously in a month-over-month sense, this is pretty strong, and I think will be supportive of markets even if they're not showing it this morning.
So Francis, is this bad news is good news, right? It's always sometimes challenging to parse through the job numbers.
It is. I think there are some bits of the jobs, as he's saying, that are sort of slowing in the background. But as long as the Fed is injecting tens of billions of dollars into the economy, into the marketplace, then we're going to have jobs numbers and consumer numbers stay fairly stable, and also elevated valuations stay fairly stable. I expect a pullback today. Obviously, we've gone up very far, very fast on a very steep angle. And so looking for the Dow to hold 29,000, looking for the S&P to hold 3290, looking for the NASDAQ to hold ultimately 9375 area. And then I see that we're going to even go higher despite some of the sort of risks in the background.
Yeah, mentioning those risks in the background, Luke, it seems like we've been feeling a little bit of respite on the trade front with some of those tariffs being halved, still uncertainty around the coronavirus. What do you think is making investors the most nervous at this point?
Well, clearly we want the trade deal to continue progressing as it is. The tariffs that were coming off from the Chinese yesterday are a good sign. They're part of the phase one trade deal, but we still view the trade deal as pretty precarious. It's very brief, only the 86 pages. They really didn't deal with the forced technology transfer issue, and we know that as we go through this year, as we've seen in the past, that it could lead into problems and it could have some backsliding. You know, sometimes it's 2 steps forward, 1 step back. So that's going to be on investors' minds. The coronavirus seems to be abating a little bit in terms of not spreading too much outside.
Interesting. But I do want to bring up the disappointing guidance that we got from Canada Goose earlier this morning in Burberry overnight. It does seem as if the economic impact, the global supply chain demand for some of these products, Francis, is starting to wane in the face of this.
Yes, I think it will, but ultimately we will not be able to tell the economic impact. So the markets are trying to price it in as quickly as possible. And again, you had the sell-off on Friday trying to aggressively price that in. Then you had the recovery because the Fed is putting $95 billion of liquidity into the marketplace. So the valuations are fluffy. The economic data in the back, it looks like growth is kind of come back and reaccelerate despite Boeing. But the thing is that the companies are starting to hit and miss. How much of that is China trade deal? How much of that is going to be coronavirus going forward? It remains to be seen. After the China trade deal, we were looking for a reacceleration in capex and manufacturing. So that's the thing that we're going to have to watch going forward to see, is the economy really reaccelerating, or are we going to start seeing cracks in the foundation, like with some of this guidance and earnings moving forward? Most of the earnings, I think, were better than expected for me this season.
And we are starting to hear from management of companies through this corporate earnings season of how they're trying to plan for the uncertainty around the coronavirus. Luke, what are you expecting or hoping to hear from management that might give investors a little bit more confidence in how, just on a macro level, these companies are handling all this uncertainty globally?
Right, so we know we're going to take a big hit in terms of food retailers, clothing retailers, and those kind of places in China that have shut down. What we're most focused on is what happens with those production and those supply chain lines like you're talking about. Just this morning, Foxconn, finding out that Foxconn has asked their people at their Shenzhen facility to stay away basically after the end of the holiday. They're still going to keep the main production facility open, which is good for iPhones and good for that, but we'll increasingly be looking for any kind of news about those supply chains and whether production factories will be up and running in China.
All right, Francis Newton Stacy, quickly before you let you go, is Uber out of the woods here, a 6% gain in profitability by the end of this year?
Well, I don't know if they're out of the woods, but they are the first company that's going to come out of this sort of highly skeptical nonprofit IPO scenario. And if the economy takes a downturn, then Uber will be more competitive than those other companies that are not profitable.
We'll have to leave it there. That's Francis Newton Stacy, Director of Portfolio Strategy at Optimal Capital, and Luke Tilley, Chief Economist at Wilmington Trust. Thank you both for your time.